Good afternoon and evening, everyone. My name is Brett Evans, and I'll be sort of running you through the webinar this afternoon, this evening, whether you're East Coast or West Coast based, just so we can make sure that everything's coming through loud and clear. Can I just get some comments in the comments field just to confirm that everyone can hear me and see me, please? Okay, so I've got some good comments coming through right now. So just to run you guys through the machinations of this afternoon, this evening, what we'll do is we'll run through a quick presentation. As we're doing that presentation, please feel free to ask any questions in the question box. And from that, what we're going to do is run a Q&A after, and certainly hit on some key points that I think will be relevant, and also to certainly cover off on some of the main topics we're discussing this evening. So we'll just be a little bit longer while we're just waiting on a few more people to join up. So we've actually had quite a good response to this evening, and I think the reason being is certainly comes down to the fact that you know, by and large, most Australian expats do hold property in some respect, whether it's as an investment or as a form of principal place of residence. So the changes that have been announced are quite draconian in our view, and we'll try and cover off on some of those main points this evening for you. So without further ado, let's get the show on the road, as they say. So I'll just start moving the information here. And can everyone see that, that presentation there? Fantastic. Okay, so tonight we're going to run through the proposed changes to the Main Residence Exemption. Give you a bit of a background. We've obviously got to cover off on always the fine print when it comes to you know, these sort of type of seminars. So obviously the presentation is being presented by us and is general information only. Obviously we do a lot of work to ensure that the information that we're presenting is correct. However, you do need to seek your own personal financial advice when it comes to making sure that you are you know, treading on the right line of the ledger. So you know, going through this, you've got to find that, you know, everyone's circumstances are different, so you can't take the information we're talking about this evening as pertinent to you. You do need to work out how it does affect you, and that's why we often recommend seeking that advice. So who is Atlas Wealth Management? We're the first and only Australian financial services firm in Australia that provides financial advice to Australian expats. We're very proud of the work we've been doing. This is our 6th year now, and certainly it's quite an exciting time from our point of view anyway, to be doing this type of work. You know, the compliance, the regulatory regime is changing around the world, not only in Australia but internationally as well, so quickly. So we're finding that what worked 2 years ago is not working today, and it keeps us busy trying to find the solutions for our clients to help them make the most of their time overseas. We're currently privileged to look after clients and provide financial advice to Aussie expats in over 18 countries. It certainly ranges from the East Coast to the West Coast of the United States, and then, you know, the major expat hubs like Hong Kong, Singapore, Dubai, London, and then we've got some great clients in some quite abstract locations too, like Laos and Mongolia. We've been nominated as finalists and as well as winning a number of domestic and international awards for the work we've been doing, and we certainly don't rest on our laurels when it comes to you know, what we're trying to provide to our clients. Who am I? Don't worry, I'm not going to talk in the third person. I'm the founder and managing director of Atlas Wealth Management. Previously I was actually an expat myself and have spent time in both the United States and also to Hong Kong. Proud to have received the Investment Advisor of the Year for 2017 and Innovator of the Year Award for 2016, and that was something that, you know, we don't do this work to receive the accolades, but it's certainly very humbling to get those awards too. Proud to work with a lot of media partnerships in terms of trying to provide our information to Australian expats. The Australian government and also governments around the world do a very poor job in communicating with the diaspora overseas. So we sort of take it upon ourselves to, you know, educate good folks like yourself, and from our point of view, that's a very important part of the process, because you can't make good investment decisions without being fully informed. So we sort of call ourselves the umbilical cord back to Australia, and we'd like to be able to provide that information out to our clients. So let's get the show on the road. What is the main residence exemption? What are we talking about, this evening? In the past, Australian expats could take advantage of the main residence exemption, and a lot of people on the line may know this already, but we'll run through that just in case. The main residence exemption is an exemption that applies both to residents and non-residents of Australia. If you formerly had a principal place of residence in Australia and you lived in that as your house, not renting it out but actually lived there itself, you had the ability to leave the country. You could rent that property out for 6 years and you did not accrue capital gains tax in that period of time, which served a very good purpose because, on average, the average Australian expat will go overseas for between 4 and 7 years. So for those who went over for a shorter period of time, they could live in their house, move overseas, rent it out while they're away, come back within that 6-year period, resume their tax residency and continue as a principal place of residence. To me, the main change that is coming out of all of this is you had a great period of time to determine what your intentions were with that property. Now, as you'll see from this evening's presentation, that time frame has been shortened quite remarkably. So what has Canberra done now? And that's often the comments we get from our clients. Canberra's always moving the goalposts. They certainly treat Australian expats now as low-hanging fruit. What we're going to talk about this evening is not a change imposed purely on expats, but as part of the larger framework that Canberra is rolling out to improve housing affordability and integrity. We all would be aware of the amount of foreign investors that are buying property in Australia, and as a result of that, what's actually occurring is Canberra is concerned that these foreign investors are pushing the prices up. So what they've done is they've imposed these new rules to try and dissuade and discourage these foreign investors. But unfortunately, that does not look at citizenship, it looks at actually domicility. So if you are a foreign resident, then whether you're an Australian expat, whether you're a Chinese citizen, whether you're a British citizen, the same rules apply. And unfortunately, expats get swept up in the changes. So what are the changes? Well, non-residents will be denied access to the main residence exemption from the 9th of May 2017. What that means is for those people who are already an expat as of the 9th of May, you will be grandfathered through to the 30th of June 2019 with respect to your existing main residence exemption. This does not account for you not accessing the full 6 years. So if you became an Australian expat on the 30th of June 2016, then you only have 3 years out of the 6. Regardless of how much time you have used, the biggest part you've got to look at all these is you need to ensure that you abide by that 30th of June 2019 deadline. So on the 21st of July, the Australian Treasury released the Explanatory Bill, and this is what they used as their interpretation of how they're going to enforce the changes that were announced in the federal budget on the 9th of May this year. So running through, a couple of the key points, we're going to address this both from existing expats' point of view and new expats. And obviously at the question and answer section towards the end, what we're going to find is we are going to try and provide a couple of case studies that give you a bit of an idea of how it works in different scenarios. So for existing expats, time is ticking. You will need to determine what you intend to do with the property between now and the 30th of June 2019. After that period of 30 June 2019, you will then fall into the new regime, and obviously any sort of tax efficiencies will be removed based on the cessation of the main residence exemption. It's obviously not good news for recent expats who will not be able to take advantage of the full 6 years. From us, there is a key issue that we're looking at, and that is what's going to occur between now and 30 June 2019. On the 21st of July, when the Treasury did release their main residence exemption explanatory bill, they did ask for submissions, and a lot of people have entered submissions basically talking about that the fair nature of the tax rules has been negated by these changes. And we're not more so talking about existing expats who do have sort of just over under 2 years to make a decision, but more so for expats who are about to move overseas. So this is the big change, and obviously existing expats will be disappointed that the 30 June 2019 rule is coming up, but for those who are about to become an expat, this is where the big change is. Not only will they be not able to access the main residence exemption, there will be no apportionment of the time spent as a resident versus a non-resident. So what we mean is you could have lived in Sydney in a property as a principal place of residence and lived there for 10 years. You then move over to LA, Chicago, New York, and for whatever reason sell that property a year into, let's call it a year into, your expatriation. The problem with that is under these new rules and based on the explanatory bill that's been outlined, it's actually going to be a 11-year capital gains liability. So it's going to go back to the initial date of purchase rather than the time away overseas. So normally what would happen is with most other asset classes there'll be an apportionment of residency versus non-residency. If you're a resident for 10 years and a non-resident for 1, then that's how they'll apply those rules. The biggest problem you've got right now is these new rules that have been proposed, there is no basis on your time in Australia versus the time out of Australia. It's all about what they call the capital gains tax event. And that capital gain tax event is determined based on when you sign the contract, where are you located. If you're located in Australia, then you are a resident. If you're located outside of Australia, you're a non-resident. So let's run through a couple of case studies this evening just to try and provide a couple of different examples of the changes and how they may affect different people. So Treasury's released a number of case studies to show their interpretation of different scenarios, and it's quite useful for us to obviously determine which way it's going to progress and how it may affect different people. So let's run through a case of Vicky. She acquired a dwelling on the 10th of September 2010, moving into it and making it her main residence or principal place of residence. On the 1st of July 2018, Vicky vacated the dwelling and moved to New York. Great choice. Vicky rented it out while she tried to sell it, and then on the 15th of October she finally signs a contract. So that is the capital gains event. The settlement's due to occur on the 30th of November 2019. As Vicky was a foreign resident for tax purposes on the 15th of October 2019, which is the day of the capital gains event. The time of the event is the key issue here. She was located in New York, she was a foreign resident for tax purposes, therefore she does not get access to the main residence exemption. And that's not just for the time in overseas, that's actually time that goes back as well too. So in the case of another one where the main residence exemption does apply, Amida acquired a dwelling. I'd love to know where Treasury gets all these names from, but Amida acquired a dwelling on the 20th of February 2003 and moves into it as a main residence. Then on the 15th of August 2020, she signs a contract to sell the dwelling. Now let's run through a breakdown of the chronology between 2003 and 2020 to see how it applies. So she resided in the property from the 20th of February 2003 to the 1st of October 2007. Then she jumped on a plane and went to Paris and rented the property out from the 2nd of October to the 2007 to the 5th of March 2011. So right now she hasn't changed her, she hasn't deemed another property as a main residence. She's still relying on that property as a main residence, and she's renting a property in Paris. She then resided in the dwelling and used it as a main residence from 2011 through to 2012, and then rented it out from 2012 to 2017 while she went to Hong Kong. She certainly got very good taste in cities, and then came back to Australia and resided in it from the 2017 until it was sold. As the property was sold on, or the capital gains event and the contract was signed on the 15th of August 2020, she was in Australia at the time and had re-established herself as a tax resident. So as a result, the main residence exemption applies for the total period. So as you can see, it's very complicated in terms of, if you are a resident, or sorry, you're an expat that does travel back and forth between Australia and your plans do change, you do need to factor these different scenarios into account. But it sort of almost simplifies things as well too, because it just means that make sure that you are a resident if you do sell your property. So going through to an example where a partial main residence exemption is denied. Now let's look at Terry, who acquired a dwelling in August 2010 On the 13th of November 2019, he signs a contract to sell the dwelling and settlement occurs in December 2019. At this time, he was a foreign resident. So he rented it out when he acquired the property until the 5th of June 2011, so from the 20th of August 2010 to 5th of June 2011. He then established the dwelling as a main residence and resided there from June 2011 to June 2019, and then moved to London, leaving the property vacant from the June 2019 until it was sold, which was November 2019. Now, in the past, you could actually leave a property vacant, and by leaving it vacant, you actually didn't get the 6 years, you got it indefinitely. As long as you left the property vacant, you did not derive income off it, you could previously have used the main residence exemption to not pay capital gains tax for the life of the property, as long as you didn't, rent the property out. In this case here, in the past, Terry would have received that benefit, but because of the change in the rules, now suddenly no longer is the case. So the time of the capital gains event was when he was in London. He was a foreign resident at the time, and even though he did live in the property as a main residence, and there was also a time that it was held as an investment property, sometimes you can look at scenarios where there's a partial main residence exemption based on the asset being used for two different purposes. So running through the list there, and this is probably to us is probably one of the biggest issues that are going to affect current expats as well too. As a current expat, you would be well aware that there is the massive transition of assets by way of baby boomers passing away and passing those assets through. So what we're going to look at today is two scenarios, both as a recipient of an inheritance and also to if you actually were to pass away overseas and owning property in Australia. So there are complicating factors here, and unfortunately in the work we deal with, on a regular basis, we're talking to clients who do pass away overseas. They don't actually have any main reason for selling, but unfortunately when you do pass away, you lose that ability to choose whether to sell or not. That asset's going to pass through to your estate, and there will be implications from that. So let's run through here and talk about some of the main issues that affect estate planning issues. So in case study 1, Con, once again love the names that Treasury is picking here, acquired a dwelling on the 7th of February 2001 and made it his main residence. He continued to reside in that property as his main residence up until his death in August 2017. Jackie, who is Con's daughter, inherited the property following Con's death. Upon inheriting the dwelling, Jackie then rented it out, and it was not her main residence at any time. So in January 2021, Jackie decides to sell that property, and settlement occurs in February 21. As she resides in Buenos Aires and is a foreign resident for the whole time she has ownership in the dwelling, she is entitled to a partial main residence exemption for the ownership interest that she has in the dwelling, being an exemption that accrued while Con used the property as his main residence. But she is not entitled to any main residence exemption that she accrued in respect to the dwelling from August 2017, which is the day that Con died and she received the property, until January 21. And this is because she's a foreign resident. So once again, it comes down to where you're located on that particular time, and that's where she signed the contract. If Jackie had sold the property on or before the 9th of August 2019, which is obviously 2 years, up to 2 years after Con's death, then she would have been entitled to the full main residence exemption. But because she sold it in a period after, then she's no longer entitled to it. So this is where we talk to clients on a regular basis about the importance of timing. So if you do have an event where your mother or father or relative passes away and they do bequeath you a property, you do need to seek financial advice at that particular point, because it could make a very big difference as to the tax liability as to whether you do get or don't get the main residence exemption. So running through to another case study here, what happens if I die overseas? And that's probably just as likely in a lot of cases, and unfortunately it's a regular part of Australian expats being overseas. Quite often they're exposed in different environments and sometimes more risky environments. So we do deal with this on a quite a regular basis, unfortunately. So let's look at Edwina, for example. She acquired a dwelling in February 2011 and then moved into that property and established it as her main residence. She resided in that property until September 2016 and then rented the property out from then when she moved to Johannesburg. She passed away in January 2018, so she's been a non-resident from September 2016 to January 2018. At that time, she was a foreign resident for tax purposes. Rebecca, who's a sister, inherits the property, and then she moves into it and establishes as her own main residence on January 2018. She continues to reside at that property and then use it as her main residence, and then she sells the property in February 2020. Now, at the time, she is still a resident. This is Rebecca, not Edwina. So Rebecca is a resident for tax purposes, and as a result gets an apportionment of the main residence exemption. The way that works is they look at the time that Edwina owned the property as a non-resident, and then the capital appreciation in that period of time does not receive the main residence exemption benefit. On the other side, then the period that Rebecca has the property, as she is a resident, and use it as a main residence, she will then in turn continue to receive the main residence exemption. So when it comes to working out the capital gains or the liabilities, you need to apportion the different periods of time. So let's run through an example of, in their case, so the period that Edwina owned the property was 2,539 days. And the period that Rebecca owned the property was 742 days. And in the case here, we're going to look at an assumed capital gain amount of $100,000. So what we need to do is we need to divide the period that the days of the ownership period divided by the non-main residence days. That's the period that Edwina held the property for. So if we take $100,000, which is the capital gain, and to divide it by that amount, then we come to a capital gains amount of $77,385. So when Rebecca does her tax return, she must include a capital gain of $77,385,000 in her tax return. So as you can see, that's a massive amount of tax, and that's the biggest issue that I think it's going to catch a lot of people out, is they are going to make decisions as to whether or not to sell the property. And we are seeing that on a regular basis at the moment with expats, given the Australian property boom that's happened, the potential of a bubble burst. People are sort of looking at scenarios, whether they lock in those profits, whether they don't lock in those profits. And what we're going to see out of all of these changes is going to be one of two things. Either people are going to try and hold on these properties past these periods and then do whatever they can not to sell that property until they come back to Australia, or there will be those existing expats who do take advantage of the grandfathering through to 30 June 2019 and look at exiting the property market then. So as you can see here, there's 1,000 different case studies we could throw out to show you different scenarios, but at the end of the day, there's always a tax implication somewhere if you are located overseas when that capital gains tax event occurs. So what we're going to do is run it through to some questions now. I know there's been a lot of questions coming through. I can see someone there looks like it's been spamming us, not sure what's going on there. So I'll start running through those questions there. And as I'm answering those questions, please feel free to jump in and ask any that you might have yourself. So I'm just going to try and get rid of... Okay, so running through. Okay, so just in the build up to this as well, I also put a couple of questions out on Twitter in terms of what our view on the property market is in Australia, and obviously given the presentation tonight, they go hand in hand as to what you are going to do in terms of changing your asset allocation, or should you be accruing assets in property in Australia or property overseas or other asset classes in Australia. So our view on the property market in Australia right now, it is very expensive. We are starting to see defaults rise to a 5-year level. Believe it or not, one of the key indicators we look at is with respect to things like serviceability of debt, percentage of debt versus income. These are all very key parts here. Actually, what I'll do is I'll jump off the screen here. So I'll just turn the screen off. Okay, can everyone see my webcam now? Great. Okay. I always find it's easy to talk to people when they can see my face, so I don't like to hide behind the PowerPoint presentations. The Australian property market is undergoing a lot of flex and a lot of change right now, and I think the biggest thing that people are considering and are concerned about is, by and large, the viability of the Australian property market given the current interest rate environment. We have seen defaults on loans at 5 years highs, and the biggest cause for concern with that is certainly the fact that interest rates are at record lows. So if interest rates are at record lows and defaults are rising, you have to wonder, what's going to happen when interest rates do start to rise. The RBA has a very difficult task when it comes to managing interest rates and those sort of things, because what they want to do is obviously stimulate the economy where possible, but also to try to influence and manage the Australian dollar. So right now the Australian dollar is trading well above its fair value, up around the 80-cent mark, 79-cent mark. The biggest cause for concern is that's actually obviously going to hurt the Australian economy. So one of the biggest things we often see is we are going to start to see changes that occur in the policy cycles that are occurring with the RBA. So normally what would happen is, if there wasn't a housing boom, the Reserve Bank would probably cut interest rates to try and bring that dollar down to improve our cost-effective competitiveness of our exports overseas. But unfortunately, if they do cut rates, then there is the possibility of inflating the property market even further. And we've started to see a lot of changes occurring in the background. One of the main things that we're looking at right now is, the change to bank lending policies. So APRA, which is the Australian Prudential Regulatory Authority, they are the, I guess, the governor of the Australian banks. And the governor, what they're doing right now is trying to manage these situations with the the banks to reduce the amount of lending that's going on surrounding investment property lending especially. So the biggest part that we're going to look at in a lot of these things is, are the banks going to lend more? Are they going to lend less? Are they going to change things? Are they going to move things around? And what we're starting to see is the banks cutting back on lending in that investment space. So we're starting to see a decrease in interest-only loans. If you are an expat and you do have an investment property in Australia, I dare say by now you would already see 1 or 2 letters surrounding the change to your facility. And virtually what they're saying is, you're a non-resident, you're an expat, therefore we're putting your interest rates up. So to me, it's a very blunt way of passing through these changes. And we're concerned about, serviceability is the big part of it as well too. So if interest rates on mortgages start to go up out of step with the Reserve Bank, that's going to hurt the default rate even further. And what's going to happen is the Australian banks, when they borrow their money, because believe it or not, they don't actually receive enough in deposits to provide those as mortgages. So what they'll do is they'll use a percentage of that, and then they'll go to the offshore markets and borrow the money overseas. Now, the problem with that is like we've seen in the US, we are going to start to see the US, we've already seen it already, they're putting up interest rates. Therefore, the bank's funding costs of those loans are going to go up. And as we know, banks aren't a charity, and as a result of that, what we're going to see is them passing those interest rates straight through to the consumer, and the RBA may or may not have any control as to how high that gets. So long story short, just be careful when you're looking at your mortgages. Reviewing those sort of things are very important, because the banks will get away with what they can get away with. But sometimes these changes out of step on the RBA can cause a bit of friction, and that's where we're going to start to see a lot of changes going through. Tracy, you asked the question, you missed the beginning. Yes, the full webinar will be available after we finish the session. We'll probably be sending out the video in around about 1 or 2 days after. It does take a while for it to save and download. So what we're going to do is we're going to actually put it up on our YouTube channel, and we'll provide a link to that as well too. So I think the biggest thing we're looking at right now is a lot of these things are moving goalposts. So what we're going to start to see out of the Main Residence Exemption is the submissions and then the response by Treasury as well too. So this is an ever-moving goalpost when it comes to the legislation in Australia. It's certainly not the big, the be-all, the end-all when it comes to what's going to happen from now on. But we think it's important that you're fully informed as to what's going on and how that may affect you as well too. So the biggest thing that I'm going to start to see out of all this, what we've seen, sitting on this side of the desk with clients overseas, is just people finding out how it affects them. That's the biggest part where we're trying to work out. Everyone's circumstances are different. If you have an investment property in Australia, it never was a principal place of residence, then there's different tax rules that apply to that as well too. So just got another question here from Tracy. We're here in the US and on an E3, which is not a PR visa, and we intend to return in 4 years. So they've been there for 3 years. What does it mean? So does that mean the interest rate will be high for the next 4 years for our investment property? Very good question, Tracy. What it means is essentially the banks will set whatever rates they think, and it's a combination of they'll take guidance from what the official cash rate is set by the RBA, but also too they'll take into account commercial factors as well too. So if their cost of funding is going to go up, then unfortunately you guys are low-hanging fruit. They would rather increase the interest rates for non-residents who aren't a core part of their business and keep Mr. and Mrs. Smith from St Mary's in Sydney happy by keeping their interest rates the same as well too. We may actually start to see those things ramp up, and we've seen a case recently with a client who actually had 2 properties. One was a principal place of residence, one was a investment property, and they did previously have the same interest rate across the board. Now there's actually about a 1.5% interest rate differential between the two. So I think that's what we're going to start to see is they're going to start to go for the easiest targets first, and then from that we're going to see a change that's going to be occurring on the banking cycle. So you need to look at different banks offering different products. The banks have always been very different when it comes to what loans they provide to what people. So some banks prefer just their bread and butter, Mr. and Mrs. Smith, Australian residents who have 2 incomes and a mortgage, and that's about it. So some banks prefer that. Other banks will actually specialise and provide more specialised results for clients. So definitely you need to talk to someone who is across all of that. We work with a number of partners who help our clients obtain mortgages in different scenarios, but we do know that since the crackdown last year because of the, defrauding of banks by Chinese citizens in falsifying their financials, now we know that the Australian banks are not giving your overseas income as much credibility as they did before. So you need to speak to someone about that too. So running through a question here from Katrina. I want to buy a property in Australia to retire there in 10 years. Is that not a good idea at the moment? This is a little bit different, Katrina, but I'll definitely address it. There is no issue, there is no correlation between the main residence exemption and you buying that property. What changed on the 8th of May 2012 was that the Australian government removed the 50% capital gains discount when it comes to investment properties. So up until the 8th of May 2012, what would happen is you could have bought that property in Sydney, Melbourne, Brisbane, and as an investment property, you would have received the 50% capital gains discount for the time that you held that property as an investment property. Now, unfortunately, once again, the Canberra saw this as a easy kill for expats and removed that 50% discount. So what it means now is that in that 10-year period before you return back to Australia, that property will continue to accrue capital gains tax with no discount at the non-resident marginal tax rate, which kicks in at 32.5 cents on the first dollar. So it can actually be a very expensive form of getting a toe in the door or foot in the door back in the Australian property market. So I think that's the key issue you need to keep in mind too is, even if you do rent that property out, you don't sell it while you're overseas, you come back to Australia and you move into the property as your principal place of residence, they are going to apportion the time that you're overseas. So even if you were back in Australia, because it was investment property, you will end up paying capital gains tax there, which is a bit different for properties that fell under the main residence exemption, which is if you get back into Australia and sell it then you don't pay capital gains tax. So it's a little bit different and probably a more of a question that needs to be answered on a personal level because just understanding that accrual, that liability in that 10 years could make a very big difference as to whether you do something or not. So let's just run through a few more questions here. Okay, so are there any other questions, guys? I know it's late in the evening on the West Coast and early in the evening on the East Coast, and we don't like to tie anyone's time up too much, and there's more important things at times to understand than just these little things. I mean, it's 1 o'clock for most people over there, so are there any other questions I can sort of address on these sort of issues? Okay, just while Jessica's writing that question, I'll answer Anathea's question here. If we move back to Australia and back into the house, can you sell the house immediately and not be charged any capital gains tax? Well, the question with this one here is certainly yes, you can, but what you need to do is you need to ensure that you are established as a resident, and that doesn't necessarily happen overnight. So what you need to do is you need to look at considerations like re-establishing yourself on Medicare, electoral rolls, paying Australian tax. You know, there is no, unfortunately, the ATO are very grey when it comes to how long it takes to establish yourself as a resident. From our point of view, we say to clients, you know, 6 to 12 months is a very conservative effort, but certainly that, you know, helps things. Once again, you know, it's different for different people because different people have different ties to Australia. But I guess the quick answer to your question, Anathea, is yes, you can sell the property, but you have to make sure that you have re-established yourself as a resident. So just by being back in the country for a couple of weeks, I guess the grey area there is how established are you back in Australia. If your kids are at school, if you're doing all those different things, I think that's the biggest thing that you need to look at is establishing yourself. The quicker you can do that, I guess, the quicker that happens as well. But you need to speak to an accountant regarding those timings. So I wouldn't just move back to the country and sell the property. I would move back to the country, seek advice, and then look to you know, basing your decisions off that. Question for Jessica: if we purchase the property in 2012 and we sell while overseas, what will the tax implication be? Because you're, I'm assuming that okay, you say it was your main residence. So I think the key indication here, Jessica, is you already have had your 6 years, which is obviously from 2012 to 2019. So now you are accruing capital gains tax at the non-resident marginal tax rate. Obviously, as we saw in the example, if you did move back to Australia and reset that, then that situation would change again as well too. So we often talk to expats about, you know, financial advice should be dynamic. It's not static. You know, it depends on your circumstances. It depends on your domicile. The other key issue you need to look at this as well too is obviously US implications as well. And if you are at the 6 years, there is the 8-year expatriation rule in the United States that a lot of people aren't aware of. And you need to consider that as well too, because what you don't want to be in the scenario is making changes to your Australian assets. And as we all know, in the US they tax worldwide, and especially if you're located in New York State or California State, and the state taxes are quite large, you don't want that overarching reach into your Australian assets as well too. So it comes down to there's so many moving parts in the advice process when it comes to A, having property as an expat, and B, having property as an expat living in the United States as well too. So, you know, certainly the parts that do move is, you know, you need to consider both jurisdictions, but also too you need to consider how you can make the most of that as well too. Okay. So Mirage has asked the question here is, what is the 8-year expat rule? This is a rule that was introduced by the IRS a number of years ago, and virtually was there to stop US citizens who build up large wealth, then leaving the country and, you know, base themselves out of Singapore, Hong Kong, Dubai, for example, and trying to avoid any sort of tax liabilities. So the biggest thing, you know, you need to consider as an expat is if you are looking to leave pre or post your 8-year time frame, how does it affect you? It doesn't affect everyone. It's based on your previous income. It's based on your assets. But there's also that implication too about, you know, a lot of people there at that 8-year mark tend to be on a green card. So, you know, there's the issues of renouncing a green card, trying to reduce your tax liability, ongoing tax liability. If you don't hand your green card, again, potentially the US can keep looking at and taxing your worldwide income as well too. So, you know, what we often find with especially our clients in the US is we do what's called a bookended advice. So we have partners in the US that provide the US side of the advice, we provide this side, and we put it together and we talk together to make sure the two match. So it is getting more and more complicated. We're not going to see any changes anytime soon. And the biggest thing you're going to start to see out of a lot of these things is, you know, what we're talking about today will be different in 12 months' time. So you need to keep on top of all those changes as well too. Okay, so is any other questions there at all? Wendy, your offices are in Brisbane, correct? Actually, Gold Coast, believe it or not. So we're in the very fortunate situation of living in a very nice climate, and we make that as a conscious rule. The good thing about our organisation is because we are digital, we're able to virtually base ourselves out of anywhere. As long as we have an airport nearby to visit clients, we have good internet and access to research. So we could actually technically be located in Kalgoorlie, but I doubt our staff members would like that. So we are in Sydney quite regularly for these sort of things, Wendy. So what I'd like you to do is, if you just want to quickly send me an email, after the presentation, the email address is Brett, B-R-E-T-T, .evans, E-V-A-N-S, at Atlas Wealth, A-T-L-A-S wealth.com.au. More than happy to talk to you offline about timings and so forth. The biggest thing that obviously I just need to work out is schedule-wise, but more than happy to work within your schedule there to look at meeting up. A question from Jessica. Sorry if you can't answer, but I wanted to know the Australian implications of selling a main residence while overseas before the 6 years of MRE. Property was purchased in 2013 and planned to sell in 2018. So, Jessica, I'm assuming that that property was previously a principal place of residence. In those sort of cases, if you have lived in a principal place of residence from 2013 and you became a non-resident after that period of time, then obviously depends on what date you departed. So, it's a bit hard to answer on that question, but long story short, if you, in the scenario, you bought the property in 2013, you lived in it as a principal place of residence, you then moved overseas in, call it 2015, and then from that 2015 period, you normally have 6 years from that time frame, so you're looking at 2021, but because the new rules are changing for existing expats, so that brings that forward through to the 30th of June 2019, from that period, then you have that ability to use the main residence exemption. So, but I think in your case, Jessica, there's probably more detail required. So, once again, hit me up on the email brett.evans@atlaswealth.com.au or info@atlaswealth.com.au too. So, more than happy to take those questions offline. Righto guys, well I know it's getting very close to 9 o'clock in New York and 6 in LA, so we might wrap this up. If there's any more questions, once again, please do talk to us offline. Our general email is info@atlaswealth.com.au, and looking forward to keeping you guys informed in future episodes. Take care and have a great day.